So, what happens when one of the hottest trades on Wall Street just completely blows up in a single day? Well, that's what we're breaking down today. We're looking at the single most dramatic day in recent financial memory, the Great Metals Crash of 2026.
Yeah, negative 31%. Just let that number sink in for a second. On January 30th, 2026, the price of silver didn't just dip, it completely cratered. We're talking about a collapse of nearly a third of its value in one single trading session. You have to go all the way back to the chaos of the 1980s to find a day that was this bad.
Look, this was not your average market correction. One report just nailed it. They called it a violent rediscovery of gravity. And that's exactly what it felt like. It was a moment where a year's worth of incredible gains just vanished, wiped out in minutes.
So the big question is, right? How does one of the market's hottest, most crowded trades just unravel so spectacularly fast? Well, to really get what happened in the crash, you first have to understand the epic, almost unbelievable rally that came right before it.
All right, so let's talk about this unprecedented supercycle. For more than a year, if you wanted to make money, precious metals were the place to be. They were the best performing asset class on the entire planet, and it was all fueled by this incredibly powerful story that people were losing faith in government-backed currencies.
And when you look at the numbers from 2025, it's just staggering. I mean, silver was up over 141%, platinum wasn't far behind, gold up over 64%. These are not normal market returns, folks. This was pure speculative fever. And when that much money rushes into one place that fast, you're basically creating the perfect setup for insane volatility.
Then in the final weeks, things just went completely parabolic. You can see it here. January 12th, silver hits a new record. Then just 2 weeks later, gold smashes through that huge psychological barrier of $5,000 an ounce. And then, the final trigger, the White House announces a massive armada is heading for Iran. The fear in the market was off the charts. You had analysts talking about a total vaporizing of trust in the US dollar. It felt like the big one was here. And then, it all came crashing down. On Friday, January 30th, you had three completely separate, really powerful forces that all hit at the exact same moment. It created the perfect financial storm.
And it wasn't just one thing. That's the key. It was this rapid-fire sequence of body blows. First, out of nowhere, you get a surprise budget deal in Washington. Boom. The fear premium that was driving prices up, instantly gone. Second, news breaks that a famously hawkish new chairman is nominated for the Fed. The market reads that as, the easy money party is over. And finally, just to make things worse, you get a sudden sell-off in big tech stocks that forces all these funds to raise cash. And how do they do it? They sell their biggest winners, which, of course, were gold and silver.
Okay, let's zoom in on that Fed nomination, because this was an absolute bombshell. The nomination of Kevin Warsh to lead the Fed, the market saw this as a complete regime change. He's known for being hawkish, which is Wall Street speak for someone who'd rather fight inflation with higher interest rates than keep asset prices floating on cheap money. You can see the difference here. It's a pivot from the easy money Powell era to a new, much tighter policy. And what happened? The US dollar soared on the news. And a soaring dollar is basically poison for commodities like gold and silver that are priced in, you guessed it, dollars.
So you put all those pieces together, and the result was just immediate, brutal carnage. It triggered this cascade of selling that just spiraled completely out of control across the entire precious metals space.
Look at this. Within just a few hours, prices didn't just fall. They shattered key psychological levels. Gold, which had just peaked near $5,600 the day before, was suddenly trading below $5,000. But silver? Wow. Silver was the real story. It went from over $120 an ounce down to $83. It lost almost a third of its value from the peak just 24 hours earlier. Unbelievable. And what made it so bad was the leverage. This whole thing was a liquidation driven by borrowed money. As the prices started to fall, you had traders getting margin calls. That's basically their broker screaming at them to put up more cash right now. And to get that cash, what do? They have to sell their positions at any price, which pushes prices down even more, which triggers more margin calls. You see how it works? It's a vicious, self-reinforcing loop. And then the exchange itself delivered the final knockout punch by raising the margin requirements mid-crash, forcing that last wave of traders to just give up and sell everything. And of course, the pain wasn't just in the metals themselves. The mining stocks, which are basically a leveraged bet on metal prices, got hit even harder. The junior miners ETF GDXJ was down 18%.
A huge producer like Pan American Silver got crushed, down a staggering 25% in one day. And for the regular retail traders who were caught up in this whole storm, the experience was just jarring. I love this quote from a user on Reddit who said, "I saw some traders make good money shorting and others clearly panic selling into the move." It really just highlights the incredible risk you take when you're chasing a market that has already gone vertical. Okay, so now that the dust has kind of settled, we're left with the big question. Was this whole thing just a violent, necessary flush of all the speculation? Or did it signal a real, fundamental change in the long-term story for metals? Because remember, the entire bull case, the whole reason metals were so hot, was built on this one massive idea: de-dollarization. The belief that countries all over the world were getting tired of the US dollar's dominance and were starting to systematically move their reserves into hard assets like gold.
And you know what? That underlying trend, it's still very much happening. The dollar's share of global reserves has been on a slow decline for more than 2 decades now. And that shift really kicked into high gear after the West froze Russia's central bank assets in 2022. That sent a huge signal to the rest of the world. So yeah, the crash was a huge short-term win for the dollar, but that long-term structural move away from it, that hasn't gone anywhere. But here's where it gets even more interesting, especially when we talk about silver. See, unlike gold, which is mostly just an investment asset, silver has this dual identity. A full 60% of all silver demand isn't from people like you and me buying coins, it's from critical industrial applications. And this is such a crucial point. The financial crash on paper did absolutely nothing to solve the physical supply shortage in the real world. 2026 was the 5th year in a row that the world actually used more silver than it mined. Why? Because demand from new solar panels, AI data centers, and electric vehicles is just surging. And this is what they call irreversible consumption. That silver gets used up, it's gone forever. And that, many analysts believe, puts a real long-term floor under the price, no matter what happens in the paper markets.
So when it's all said and done, what was this? Was it a reset or was it a warning? Ultimately, I think the great crash of 2026 was just a brutal lesson in how a crowded, over-leveraged trade can unwind. It proved that even in a world that seems to be losing faith in traditional currencies, a short-term liquidity crisis can totally override any long-term story. The big question now is, for how long?